Hear me now?
Yep.
Yes.
Excellent. Hey everyone. Hello, Nevin. Really great to meet you. Long-time investor in Reserve and really love the mission. Um, Now, my question for you, Nevin, is with regulators going after stablecoins, how do you think Reserve is positioned currently, now and in the future to deal with regulatory hurdles and headwinds?
Um, yeah, it's a good question. So, the way that we approach regulation generally as a project is, basically to just design things within the laws. We sort of take the laws as, rules that we need to follow. And the interesting thing about deploying a protocol on something like Ethereum is that once you've deployed the code, it's just there. And so it's an interesting question, like, you know, could future laws come into existence that would make something that we've deployed have a different legal status from what it had when we deployed it? And the answer is, well, yes, of course. I mean, laws could be changed, and who knows what could happen. But so this AMA is focused on the protocol. So I'm going to answer the question from the perspective of how we're thinking about the protocol. Um, we've been pretty careful to design the protocol in such a way where we think it fits into existing legal regimes, at least in the U.S. and in other countries that we're familiar with, and then because of the fact that it will become decentralized and will be out of our control, like many crypto projects end up being, then in the future it will continue to exist regardless of whether people like it or dislike it, regardless of whether laws are meant to allow it or not. Now, I'm not here to be like an anarchist and try to break the law. Like, I'm personally, I appreciate laws and I appreciate order in society. So that's not really the main objective or anything. It's just that that's kind of a fact of how crypto protocols tend to work. So that being said, there is, it obviously still matters whether or not our protocol is considered, legal and okay for people to access and use. Like, people talk about how like it's difficult to shut off Bitcoin, and that's true. It would be very, very difficult to shut off Bitcoin, but any given country could just outlaw the usage. They could just say it's illegal to hold Bitcoin, it's illegal to send it, it's illegal to trade it, and it would end up being something much more like, I don't know, someone who's like a drug dealer or something. If you're dealing with that asset, and so clearly we as a society have the ability to limit the usage of these technologies, to limit the acceptability of these technologies, even if we don't have the ability to shut them off. And so from that perspective, whether or not regulators around the world decide it's okay or not for people to use the form of money that we are putting out into the world will matter. It will matter. And, that's something that maybe we'll end up playing a hand in that. Maybe we'll end up interfacing with regulators and trying to shape their decisions. Maybe we won't. But it's kind of a question of, what do we as a society want to do? What do we as a society want to allow? The last thing I'll say that's relevant to the protocol in terms of how we think about regulation, I think the biggest thing that I worry about with the protocol is that I would like it to be that all financial assets and all commodities end up tokenized and available to be collateral in reserve tokens. I think that the best currencies that we could construct as a society might actually be, super diversified baskets of assets that include lots of things that are regulated, that would today be considered securities and would only be traded on limited exchanges. And so I think that the long-term, like, full prosperity of the reserve protocol would likely be the highest if we as an industry can manage to find ways to get those assets on chain in a way where they're allowed, not in the sort of way like we have right now with sort of like synthetic tokenized equities, where it's kind of a gray area, or I mean, it's not even really a gray area. It's just something that centralized exchanges won't even touch because I think a lot of them are considered securities. if we can manage to have a regulatory regime that allows for these assets to exist, for people to send back and forth permissionlessly, and for smart contracts to hold and transact, I think that can lead to a lot of cool stuff, not just what we'll do with it, but if we don't manage to make those choices as a society, that could limit the potential for something like the reserve protocol and many other applications on Ethereum. So that's something where a lot of people in crypto are worried about things becoming more regulated and more restricted. And I actually, this might sound crazy, but I'm actually a believer that we might be able to evolve some regulations and actually allow for some activities that maybe currently we don't allow for. And I guess I'll just leave it at that. It's a little bit hard to justify why I believe that, but basically, I think some of the regulatory regimes that have been crafted don't apply as much if you're operating transparently, if you're operating in an environment where everyone can see all the transactions that happened, where the records are public, and especially where like the governance decisions are public. It actually is a fundamentally different situation from companies operating in private and securities being traded in a way where the exchanges have privileged access to information and so on. So I hope that we can actually allow for more assets being less regulated and available on chain in the future. And that is something that would be good for Reserve. And if that doesn't happen, then the Reserve protocol may have more trouble reaching its full potential.
Brilliant. Thanks very much, Nevin. I really appreciate it.
Yeah, thank you for the question.
Thank you.
Thank you. Raccoon, are you here?
Hey, yeah, I'm here. I really appreciate you doing this, Nevin, and I'm a big fan of the new protocol.
Awesome.
I just had a question. So given the new verbiage on the protocol, and I believe I heard in the last podcast that you're working on the security of the release, I was just wondering if everything's still on track for mainnet to happen in Q4.
Well, as we've said, you never know until it's done. And so, as usual, I won't be surprised if things take longer than we would like them to. So it's totally possible that it will take longer. We're pushing. Our protocol team is working hard, most days of the week to make that happen. But it all comes down to, can we keep on those schedules? Can we get things audited in time? It's certainly going to be very late in this quarter if we make that deadline, and it could end up being in the next quarter. And I hope that before too long, we'll end up having enough certainty to actually set a date or a target range, so that it's a little bit more clear. I do want people to know as clearly as possible, but right now there's still enough things that could happen that we can't be totally sure. Let me share a little bit of explanation for what our development process actually looks like. That might be interesting if you're trying to understand why I'm giving this answer, or trying to guess how long it could take. So because smart contract development is so high stakes, because of the fact that if we get it wrong and there's a bug, then lots of money could be stolen, and the reputation of the Reserve protocol could be sort of destroyed. Obviously, we're super concerned with getting it right the first time. There's really just no other option if we want to succeed. And so because of that, we're actually taking a route to implementation that's here's how it works. So we've defined the protocol in abstract terms, and we've actually written one version of smart contracts already, but now we've gone back and we're implementing the entire protocol in a slightly simplified way, in a way that doesn't really quite contemplate all of the intricacies that you have to take into account with blockchain development, in terms of how you handle math and solidity and so on and so forth, having to do everything in constant time. We're implementing everything in a language called TypeScript, and so there's a prototype version that's simpler and easier to think about. It's easier to look at that code and reason about, does this do exactly what our protocol definition wants it to do? And then we're implementing a second prototype that's also in TypeScript, that is more complicated, that starts to account for, the complicated ways you have to handle math in smart contracts and some other things like that. And then we're implementing, sort of, like I said, we already have done one version of smart contracts. We're going to implement the final version of the smart contracts. And then we have these really cool tests that can basically tell whether these three systems, the first prototype, the second prototype, and the final contracts, are like equivalent in the relevant sense. And those tests, basically the way they work is they generate like lots and lots of values and run lots and lots of transactions in like a way that's meant to kind of cover the space of possibilities and check and make sure that they get the exact same result across all three different systems, in order to help us tell like, okay, yes, these three actually are equivalent. And so with that testing, then we can say, okay, if this simple system does what we think it should do, and that's easier to think about, then that gives us a good sort of basis for believing that the more complicated smart contracts are also going to behave exactly the way we want them to. Obviously, we also have to rely on external auditors to help us with that, to run tests that we didn't think of running, and we'll very likely run a bug bounty as well, so that if anyone finds a way to hack the smart contracts, we can reward them for that instead of them stealing people's money. But so it's basically that process, that development process, that gives us that uncertainty where it's like, well, exactly how long is it going to take to implement all of those tests and all those systems? And if things do go wrong, if we find problems, how long does it take to fix those and change things? And we're still just in that implementation phase. And so we just can't tell exactly how long it's going to take before it's ready. And then as soon as it is ready, and we've gained the relevant confidence and security, then we'll be putting it out.
No, that's great. I really appreciate you going in depth about that. It sounds like you guys are kind of, looking out for everything that could possibly happen and make sure you're totally prepared for when it does happen.
Yep.
So I really appreciate that explanation. Thank you.
Yeah, you're welcome.
Thank you, Raccoon. So I just want to quickly remind everyone, if you have a question for Nevin, you can use the request a speaker feature, and then we'll pick someone at random to ask the question. If you don't have that feature, since you're on desktop or anything else, then you can also just reply to the Twitter Spaces tweet that we just put out, just as a small reminder. Nevin, I have a question from a Twitter user in the meantime. It's from RSR Goat, and he asked, I'm going to read what he says. He says, Nevin mentioned that if the yield of staking is above the risk of default, so I think he means in general, like the yield of staking will be more than a potential risk, like funds being slashed, then it likely makes sense to stake RSR. But he says, but people in crypto expect high APYs. So his question is a lack of staking involvement a concern for Reserve? And his second question regarding that is, would the team stake part of the slow wallet to have enough insurance on any of the RTokens?
Very good questions. So let me start with a little bit of mechanism discussion, and then I'll answer that second question as well. So one thing that's important to understand about the staking rewards is that they are a function of how many people have staked, or how much RSR has been staked, I should say. So let's say that there's, I like to use small numbers, for example, so that they're easy to think about. Let's say that there's an RToken that exists, and it has, I don't know, $100 of annual revenue is what it produces. And then, so if you were to go, and if nobody had staked their RSR, and you go stake $1 worth of RSR, and you're the only staker, well, you would get all of that $100 of revenue. So you would get, like 100x return on your capital. You would put in $1, you sort of staked $1, and you get $100 per year. So you're getting 100x yields. Obviously, that would be like a ridiculous multiple, and that's unlikely to occur because someone else would be like, oh, wow, this is like a crazy yield. I should go stake my $1 of RSR. And now then each of those two stakers would each get $50 of return. So they'd each get 50x return. Well, you can see people would keep wanting to stake while the returns are very high, until eventually you get to an equilibrium point where, I don't know, let's say that, all right. So we were talking about the basics of the fact that there would be an incentive for more people to stake if very few had staked. I think that hopefully that makes sense to people. So, again, if in that example, if you had, $100 in revenue available, and only 2 people had staked, $1 each, then we'd each be getting a 50x return. So you expect more and more people to stake until you get to that equilibrium where the return is like basically competitive with the market. So let's say people in crypto, are willing to stake volatile assets like RSR for, I don't really know, let's say at a particular moment in time, because this will change over time depending on what sort of deals are available to people. Let's say at a particular moment in time, it's 20%. Well, so when that 50x goes down and down and down and down and down till it's 0.2x or 20%, well, that's the equilibrium point where you would expect people to no longer be interested in going out and actively buying RSR in order to go stake it and earn that return. And so there's still, I think, a caveat there, which is if you're a long-term RSR holder and you have the opportunity to stake for a lower yield than you might get on other opportunities in crypto, then that might still be like just a bonus. It's like a lot of people on this call might be holding RSR despite having earned no staking rewards to date. And so, that fundamental reason to hold RSR, maybe that would still exist. And so if that's true, it's like, well, maybe you'd be willing to stake for only, 5% or even only 1%, because it's like, well, why not? If you believe that the risk is low. So there is that caveat that it could be that you end up seeing more staking than would just come from people actively going out and buying RSR to stake just because the yield was so high. To answer the question of, are we concerned about that? I wouldn't say we're concerned. It's something that we think about. We think about the, sort of the math and the incentives with respect to, how much revenue would be necessary in order to get different levels of backing. The thing is that I don't believe that it's necessary to have like 100% insurance, right? Like if the RToken has a market cap of, whatever, again, let's just say it's like only $100. I don't think you need $100 worth of RSR insurance in order to have like a meaningful buffer that would actually help in the case of a collateral token default. If you have, say, I don't know, let's say you have 5 collateral tokens, well then, in order to be able to cover one collateral token defaulting, you would need a 20% buffer in terms of the value of the staked RSR. So based on some basic math, well, somewhat complicated, honestly, math that our protocol team has done, we feel like it's quite reasonable to expect that there could be RToken designs that have enough revenue in order to generate 20% or 30% or a little bit higher in terms of the value of the staked RSR without a problem, just based on those like rational incentives compared to other market opportunities. But I will totally point out that you can easily construct an RToken that generates no revenue. And so if you have an RToken that generates no revenue or very little revenue, then you just shouldn't expect it to be insured. Let's say that there's 0 revenue, well then there's 0 financial incentive to stake. And so in that case, and the RToken protocol can be used that way. You can use it to construct baskets where there basically isn't any insurance involved. And so in that case, the RToken holders are just holding that basket directly. And if there's any problem with any of those underlying tokens, then they directly have to deal with that problem. Now, it's generally going to be the case that a basket that generates no revenue is likely to be lower risk as well, because we're probably talking about either crypto assets that are not pegged to anything, or crypto assets that are pegged, they're asset backed or something, and there's no appreciation involved. There's no lending demand for them, and so because of that, I think it can make sense, and I think that we actually will see uses of the RToken protocol that have insurance and uses of the protocol that don't have insurance. And so, but it's really, again, it's really sort of up to people out in the world to decide which baskets to create over the course of time. So, like we've mentioned, we'll be starting with 2 tokens ourselves. One that's very similar to the current RSV. It's just backed by fiat-backed stablecoins, and that one, in the short term at least, will continue to not generate any revenue. And so in that case, we don't expect there to be insurance. And then the second one will be based on dollar-denominated DeFi tokens that are like dollars with yield baked in, that will generate revenue. And so we do anticipate there being a significant amount of insurance. And so to get to that last part of the question of, do we intend to remedy this by staking our own RSR for tokens that that don't necessarily have enough reward for there to be insurance? The answer is not necessarily, no. I think that it makes sense to let the protocol operate as it's designed, and so for that token that doesn't generate any revenue, I don't think that it would be appropriate for us to voluntarily stake RSR, with no benefit in order to provide insurance, because that's sort of providing a false sense of security, or like a false security blanket that could lead to people buying and holding and using that token with the belief that it would be insured. But maybe in the long term, if it were to get big enough, maybe we wouldn't have enough capital to actually provide that insurance. Or maybe maybe there'd be a reason why we wouldn't be able to use those tokens that way anymore. And so I always try to make sure that we wouldn't create a situation where people rely on an element of safety that wouldn't actually be lasting. And so I think it's better to try to structure things where the economic incentives are basically providing whatever safety exists, so that safety is likely to exist on into the future.
Thank you, Nevin. Priceline, are you here?
Yes, I'm here. Sorry to ask so many questions. I was told that there were some questions I should still ask, though. In regards to privacy for the stablecoins, can you talk more about what might happen with RS yield, as we might call it, or even the RToken system? Will you be able to expand on privacy for the entire platform?
Yep. So privacy is a really challenging question in the crypto world overall right now, and we are no exception to that. And the reason I think it's so challenging is because if you think about, especially, it's interesting. Privacy almost hasn't been an issue in crypto in large part so far, because we're mostly using it in private. Like when you are interacting with DeFi, or when you're interacting with exchanges, you're only ever interacting either like pseudonymously in a way where people like don't really know who you are, or you're interacting with these sort of large financial entities, like Coinbase or Binance or whatever, where it's almost like they're a bank, and it's like, yeah, I'm kind of fine with them having my information. That's pretty different from if you think about like all of the financial transactions that you do in a week or in a month, in terms of paying your landlord for rent, or going to the grocery store and making a purchase, or if you run a business, all the people that make transactions with you to buy things. If everybody who's transacting in a normal economy can just see how much money everybody else has, and can see the kinds of purchases, at least in the abstract, that each other are making, that's a very different reality from what we live in today. And I think that that's a level of exposure that I personally believe people might not really be okay with. And I think it would be rational to not necessarily be okay with that. And so because of that, I think there's a really clear reason to expect that we need privacy technology. We actually need to allow people to make those transactions and not have all of their financial information in terms of how much money and who they transact with to be shared with with all the people that they're transacting with. But so that's one part of the argument. But then the reason, obviously, I think is sort of pretty well understood by this crowd. The reason why it's so sticky is that governments don't like privacy technology. Governments want to be able to keep track of who is transacting with whom in order to basically spot crime and stop it, which makes sense. People have different opinions about the level of surveillance that's appropriate, and I do think it is taken too far sometimes. But you can understand as a regulator why you would want that tool. So I honestly, I think it's pretty unclear what's going to happen and how this is all going to shake out. But there's an interesting corollary to what happened with the early internet, where at the beginning of the internet, and I'm citing my understanding of this story from some writing in a book and some things that Zuko from Zcash told me in person. So I might get some of this a little bit wrong, but my understanding is that at the beginning of the internet, there was a big debate about how to deal with encrypted traffic. And many people from government, from the NSA in particular, were concerned that if encryption technology were open source and available to everyone and everything was encrypted, that would permit all sorts of criminals coordinating with each other, and the government wouldn't be able to track that, and this could be catastrophic. And so there was a lot of effort put into trying to make it actually so that all encrypted traffic would go through particular chips that the NSA had a backdoor into it. And this wasn't even a secret thing. It was an official program, and these chips were actually manufactured and they started to get into production. And apparently what ended up happening is e-commerce started to get popular. And so all of these websites that were offering e-commerce were well, we can't just we can't just wait around for this government designed system to be fully deployed before we offer encryption, because people are sending their credit card numbers back and forth to our websites to buy things. So all these websites just started implementing, encrypted portals to their website. And so encryption technology, really became widespread in order to protect people's credit card numbers, so that they could make transactions online. Because, for a similar reason, people don't want their credit card numbers just floating around on the internet for everyone. And so I think we could end up seeing something like that with crypto as it starts to become used as money, right? Which is a relatively new thing. We're, whatever it is, 12 years into Bitcoin, and we're still only seeing the beginning of, stablecoins having been invented and worked out, and then technology like what we've built with the Reserve app and so on, where people are starting to use crypto as money. Once we switch over and have transactions on chain, there might be a huge need for that. It might be that all of our customers would be unwilling to keep using the app for transactions if all those transactions on chain are fully public. And so it might be sort of an analog to that situation with e-commerce websites needing to encrypt in order to protect credit card numbers. And so if we get to that point, then maybe a similar thing will happen as what happened with the internet, where at that point, my understanding is that regulators were kind of yeah, okay, we see your point. You can't really just have people's financial information, flying around unencrypted. So we see why you did that. And now that the encryption technology is out there and kind of used by everyone, I guess we'll just have to figure it out. And so I actually think that if there is that strong, legitimate use for privacy, right? And this is legitimate in the eyes of the government. Regulators will be able to look at this and be well, I can relate to that. I wouldn't want, all of the businesses I transact with and all the people I transact with to know how much money I have and who else I transact with. If we get to the point where that's actually understandable to people because it's happening in practice, then I think that the conversation could shift. So I realize I keep giving these really long answers. So I'm sorry about that, but the answers to your questions, these are complicated questions and the answers are kind of complicated. So when it comes to the question of are we going to make it so that our tokens can be used privately? The answer is I think probably eventually yes, but we do have to worry about how governments see the Reserve project. and we do have to, we have to actually take their concerns seriously as well. And so I think the answer is going to be yes. I think that we might actually see more of a societal shift towards appreciating privacy in cryptocurrency, but we're not there yet, right? It's mostly hostile from the perspective of governments for now, and so we're going to kind of wait and see for a little bit longer. Like, it's not the case that, like, we don't have like early next year plans to support privacy versions of the coins in our app or anything like that. So we're going to wait and see, and probably end up in dialogue with regulators about like how the world is going to address this. And I think that the answer is probably going to be privacy technology for everybody.
Okay. In a similar vein to that, inside the app, will you offer self-custody? Like, is that pretty early in after mainnet, or is that something that we don't really know?
People probably get tired of me saying that we don't really know, but it's something that is like very important in the midterm. It's not our near-term priority because there's a lot that we can do in terms of growth and serving more users before making that switch. But I will be disappointed if we haven't managed to make the switch to doing those transactions on chain next year. Like, if it's later than next year before we make that switch, I'll be disappointed. But I wouldn't be completely shocked. Like, every few months, we evaluate our strategic priorities, and so far that has never ended up being number one, because there's like so much complexity we're dealing with. So it could be that it ends up taking longer and doesn't happen in the next calendar year.
Thank you very much. Thank you.
Thank you, Bryce. Raccoon, I'll let you ask your question in just a second. I'm gonna go and ask one more question that we received on Twitter. The question is, for the basket of tokens that will be backing a new RToken, will there be a list of approved tokens that can be used? Or is there a possibility that users can create baskets from any tokens of their choice? And this last question is that list of tokens you can choose from, is that limited to stable coins, or are volatile tokens allowed? And maybe Nevin, you can expand a bit on like what the consequences of each choice could be.
Yeah. So there is no whitelist or anything. Like, if you deploy a new RToken, you can include any tokens in the basket. So we could see people do experiments with volatile assets as well. Someone asked a question on the AMA earlier today: what would happen if there's like a rebasing token? And we don't have an answer to that. Like, the protocol isn't necessarily designed to accommodate that. So it could be that there's some tokens that you could include that would somehow break the protocol. But for any ordinary ERC20 tokens, they would work. However, if you want the basket to be insured, like if you want the RSR backing mechanism to apply, then in general it needs to be that there is a class of tokens that have like similar properties. Like, for instance, compound USDC can easily be sort of backed up by USDC, which could be backed up by Paxos, because it's like a little bit nuanced to explain why this is, but basically, if you have two tokens that are just like freely volatile with respect to each other, like say USDC and ETH, for instance, well, they're always going to be changing in value relative to one another. So what does a default mean? Like, how do you define a default? It's pretty unclear. Whereas if you have like compound USDC and USDC, compound USDC is supposed to always appreciate relative to USDC. So you can define certain price, like sort of price change definitions that would actually give you a structured way of thinking about what a default is, and will give the protocol a structured way of reacting, and basically declaring default. So what that means is that it still doesn't limit which ERC20 tokens you can include. You could still include volatile tokens. you just probably wouldn't be able to include volatile tokens and have them be insured. So what that would mean is that the RToken holder would just basically inherit that volatility, unless there are like multiple versions of a volatile token. So for instance, let's say that there's like 3 versions of wrapped Bitcoin on Ethereum. Like if that were the case, you could have one token as part of the main basket, and then you could have those other versions of wrapped Bitcoin as backups, so that if the first one breaks for some reason, then the RSR stakers could pay to basically recapitalize with one of the other ones. So basically, you need tokens that have like sort of tight relation in terms of their value for the insurance mechanism to work. But other than that, it's open to experimentation.
Thank you. Raccoon?
Hey again. So I kind of get confused, I guess, when coins are and aren't considered a security. As far as I know, RSR is considered a security right now. I was wondering when mainnet hits if RSR won't be considered a security.
RSR is not considered a security. We don't offer its trading in the US just out of conservatism. And at the point of mainnet, it still won't be considered a security. There's kind of like a long, complicated analysis as to why that is. But generally, when you talk to your lawyers about that, we get into all the details of the analysis, but they generally don't recommend that we go talk about the analysis publicly. I'm actually not sure if that's, I don't know, maybe we should just publish the analysis at some point. But yeah, so after mainnet, it will still be the case that in our view, RSR isn't a security.
Okay, great. I had one more question, if that's okay.
Yeah.
About the RTokens. I know Reserve recently invested in Lemon Cash, and I was wondering if you guys heard anything from them about potentially being a one of the first fintech companies to create an RToken, if you could even speak on that.
Yeah, it's a good question. I don't actually know if our teams have talked to each other about that. But yeah, I think Lemon Cash is awesome. For those of you who don't know, it's an app in Argentina that allows you to really easily buy and sell stablecoins as like an ordinary fintech type user. We're certainly interested in Reserve being available in that app and usable that way, because we think it's a great product. Whether or not they would create their own RToken is an interesting question. It could make more sense to just include the yield generating RToken that we create, but it could be that they'd be interested in creating their own. So I guess we'll see. Yeah, we'll see what they want to do.
Is it okay if I ask one more question? I'm sorry.
One more.
Okay, thanks. The new RToken that is going to act like a savings account in the Reserve app now, is that going to be released before mainnet, or will that have to be after mainnet?
It'll basically be released at the moment of mainnet, because it is implemented by the new protocol. So basically that token depends on this new technology that's in development. So basically at the point of mainnet launch, that token will be deployed.
All right, great. Thank you so much.
Yeah, thank you.
Thank you, Raccoon. I just want to remind everyone, if you have a question for Nevin, you can use the request to speak feature, or you can reply to the tweet that we put out for the Twitter Spaces, just in case that people aren't aware of that just yet. I have another question here from the community, and it's a scenario. It's basically asking how you talked, Nevin, about when you stake your RSR, you get a token that is tradable that represents that staked RSR. Now, and this person asks how exactly that would look, and he wrote down a scenario. And the scenario is, let's say you stake 100 RSR and you receive 100 the token of 100 staked RSR in exchange. Let's say a year passes, and now those 100 RSR are worth 100 let me see. He says a year passes, and now those 100 RSR are 105
Yep.
RSR. Okay, how do you redeem those 105 RSR with only 100 staked RSR tokens? I think that's the
Right.
question. Could you explain how that mechanism looks?
Yeah. So basically, it's a good question. So basically, the way to think about it is that those staked RSR tokens, we need to name these still, but the tokens that represent your staked RSR position, they become redeemable for more RSR as you earn staking rewards. So that just means that those 100 tokens would be redeemable for 105 RSR at the end of the year. And that's actually somewhat similar to how like compound works. Like you get, when you deposit USDC, you get CUSDC, compound USDC, and that just becomes redeemable for more USDC over the course of time as yield is generated. So similar pattern here. I hate to do this, but let's take one more question. This will be the last question. I have to jump off right at the end of the hour because I have an interview scheduled with a candidate. And so I want to make sure I don't leave them waiting.
Yep, that's perfect. Jimmy, are you here?
Yeah, I'm just curious as to why you guys are doing Tether as 1/3.
Well,
like you do know they're under investigation, right?
So okay. So you're talking about Tether is included in this new RToken that we're designing. Yeah. Well, I mean, the short answer is we have to think about the yield for that token, and if we're aiming to create something that is competitive for crypto users for the entire crypto ecosystem, then if it's the case that USDT has significant yield in lending protocols, then if we don't include it and other tokens that end up exhibiting similar properties to our stablecoin do end up including it, then that would mean that the RToken would be less competitive. But the other side of the coin is, like you just said, it's like, well, what if they're under investigation or whatever? I think that the way to think about that, in part at least, is what is the market saying about how it feels about Tether? I mean, Tether is still the largest stablecoin, so it's clear that the market of cryptocurrency users, in terms of the overall ecosystem, broadly continue to trust that Tether will continue to be worth $1. And I personally also do too. I think that there's certainly a threshold where if we, or I guess once it's deployed, the governors of the protocol, which won't really exactly be us, like if there ends up being sufficient concern that Tether is actually a bad idea to hold from a financial perspective, then it'll get voted out. And it could even be that we make that decision before the launch of the protocol if significant negative news comes out. But Tether has been under investigation in the past. And I personally met the people who created Tether and some of the people who run it, and I tend to think that the market is probably right about Tether continuing to be relatively likely, relatively trustworthy and likely to be worth $1. So that's just my personal opinion, though. Like, it's not that my personal opinion should govern that decision, and that's part of the part of what comes along with giving away governance of this protocol over time. Is making it so that my opinion ends up not being the relevant one. So it could be that even if we include it, maybe it will be short-lived. We'll find out. It's a good question. Thank you for asking. Great.